This is me. I'm Trevor Cave. Again, I'm senior loan officer at Jackson Henry Mortgage. I've been in the industry of real estate and mortgage for over 25 years. I was a real estate broker for 20 years, and I've been a mortgage loan officer originator for 6 years now. So I have quite a lot of experience in the industry in many ways that I can assist you with. I specialize in all kind of loan products. This is some of them that you see here. I really kind of want to make this go somewhere else. But anyway, so we'll get into more of these as we go along. So the first product I want to talk to you guys about is renovation loans. How many of y'all know what renovation loans are or have ever used them? Anybody? All right. So just quick.
Would a refi be a renovation product?
It can be a refi or a purchase.
A cash out or cash out refi?
We used to only be able to do these on primary residences, but we can now do them on investment property. Okay, so they've become very useful, and there are two types of renovation loans. There's a 203K, which is the FHA version of it, and then there's the home style. Okay, the 203K. These loan limits are outdated. The one unit now is like 470,000 this year is the maximum FHA loan limit now, and I don't really remember what the other ones are, but they can go up to quite a bit. I think 4 units now is over $1 million. Okay, for an FHA, and so long as your borrower lives in one of the units, they get to call it a primary residence. Okay. So that's why you do multiple units. Now, the maximum renovation expense on these it's pretty much unlimited. So you can pretty much take the property. All the requirement is you have to use the existing foundation. So you can literally take the old property, scrape it off the existing foundation, and build on it. Okay, and what they loan up to is 96.5% of the ARV, which is the after repair value of the property. You cannot do any luxury items. Okay, no pools, no ADUs, no outdoor kitchens or anything like that. Simply, you can fix everything to do with the property, but no luxury items.
Is a Tesla charger, is that considered a luxury item? It is. Okay.
Yeah. Most likely, yeah. Yeah, but then again, who knows? I mean, in today's homes, if you're you got an electric car, you need an electric charger. Probably not. Actually, I would think that would be fine. Okay, because it's part of it's the structure. You just can't. Big thing is like you can't put a pool in. Okay, different on a home style. Home style, you can put a pool in. If you want to build an additional dwelling unit on the property, you can do that with a home style. Can't do it with an FHA. Okay. Caveat though, like let's say you did want to build a garage and put an additional dwelling unit on it, so long as you connect it to the existing property, like with a breezeway or something, that works. Okay, yeah. So you can do something like that. These loans require the involvement of a HUD consultant, which is somebody that sits in between the bank and the borrower. Okay. The contractors are very important in these loans. If you're ever going to get involved in these loans, particularly from a purchase standpoint, okay, they're really good for purchasing. They're really good to expand your borrower's depth of homes and what they can consider. Okay, particularly you got like that really picky borrower who's like, every house they walk into, oh, I don't like the kitchen. Oh, I don't like the bathroom. Oh, I don't like this. Great, fine. We'll buy it and we'll do a renovation part of it. You get, we can fix everything you want. Okay. And it can be as little or as much as you want. What I'm talking about here is a 203K full. Okay. Which is a full version of a 203K is anything over $35,000 that's non-structural repairs. So no structural repairs I'm sorry. Anything over $35,000. So is a full. Okay. And we'll talk about limited in a minute. Big thing when you're doing these, if you're ever thinking about getting into using these, let me know up front. Okay. Before you start shopping for homes like this. you'll want to involve me in the process of I'm working with a realtor right now where I'm teaching her how to use these things, and taught her how to find them. And I'm pretty good at estimating work to be done. So if you're working with a client, I will go with you to look at these. Okay. But you want to give yourself at least 45 days, if not 60 days to do these deals when you're starting from a purchase standpoint. Picking a contractor is a huge part of this program. They're the most important thing that you have to deal with early and upfront. So contractors have to be vetted. They have to be a particular kind of contractor. So, if you're going to go after these things, it's a good time. It's good before you even start looking at properties that you identify a contractor that you want to work with. I have ones that I work with that are already approved with the banks and things. So if I do have guys that you can come to me and we can get going right away. All right. But so just very important, if you're going to get involved in these, talk to me first. Okay. And I'll help you get, I'm very good at these. I've been an expert at doing these for a long time. Okay.
So I have a couple of questions. So you said this is just for if they live in it, single family. So it's not for an investor. Investors
Correct.
can't.
The 203K is only primary residence. You can
Okay.
only use this for primary residence.
Okay. And so if they're guys, one thing I wanted to point out and make sure that y'all picked up that he said is if you're working with a buyer or a seller, if you're working with a seller and then you get an offer in on your listing and it's a 203K, it's going to take 45 to 60 days to kind of close, no matter what they wrote on the paperwork, because he's saying it's taking 45 to 60 days.
And you better be really careful if somebody floats across an offer letter to you with 203K. That loan officer better know what they are doing. And then you better ask questions like, oh, have you had your contractor identified? Have you already had them approved? Their paperwork approved? I mean, those are the things that will really slow things down if you don't get them out of the way first. Okay.
Yeah, and if you're working with the buyer, make sure you write up that contract and you talk with the other agent and that they know it's a 45 to 60 day close.
Mm-hmm. Yep. 45 is really okay. I mean, so long as where we get into problems, if you go and write an offer on that you're intending to use a 203K and you haven't talked to me and you haven't decided on a contractor and you're just going at it right out of the gate, you're going to have problems. And, then we're going to be probably longer than 45 days. Okay. So just they're great loans. They're really useful. Just, particularly if you're going to do a full one, they do require quite a bit more. They can be done in manufactured homes. Credit scores are a minimum 620. Okay. And again, you can go up 96.5% of ARV. Okay. Now the 203K limited. Now this is for anything under $35,000 in repairs that doesn't involve any structural things. So we're not moving any walls. We're not doing any foundation work, but you can replace a roof. You can do HVAC systems. You can update a bathroom. You do a kitchen. So long as the work is under $35,000, it'll qualify for a limited. Now this is a much more quick process. These do not have a HUD consultant. They do not require a draw schedule. It's 50% up front to the contractor, 50% on completion. So the contractors can, they will operate with these much easier than a full 203K or a full renovation loan. The contractors have to be much more stable monetarily as a business. They have to be able to front some money when they're doing a full one. So, but these are much easier. So again, this is great for the guy who hates something in the house and just always doesn't like the flooring, doesn't like the floor, doesn't like, the kitchen, whatever. And if it's under 35,000, this is a great way to do it. Okay.
So if they have a buyer and they're walking through a house and they say, man, if this, air conditioner was just updated, I'd buy this house. They could suggest, okay, well, you can go ahead and buy it because you can apply for a 203K, an FHA 203K loan, and that covers the cost of the house and plus what, 10, 20,000 over for the air conditioner? How does that work?
So again, it's based on the ARV of the home. So the appraisal will be done with the idea that the HVAC is updated or the kitchen is updated or the roof is replaced. Okay. And so long as the value of the home comes in, let's say you write a contract for 300 on a house, and you want to replace a $15,000 HVAC system. Well, the house will need to come in at 315 on the appraisal, okay, in order for the same ratios to stay. They only do, they get 96.5% of the ARV. So, they would still have it at now 3.5% down on 315, but it just has to appraise with whatever you're adding on in terms of value.
Do they give the extra over what the contract is? Do they give that to the buyer, or do they pay that directly to the contractor?
So the contract's written for 300,000 with 3.5% down. That's what you wrote the contract for. Okay.
Right. And that includes the air conditioner, or does not?
That's what you bought the house for. Okay. But you're doing a 203K. So you're asking for, when we're setting up the loan, we're setting up a loan based on $315,000. Okay. With the idea, with 15,000 set aside for doing the HVAC system in an escrow fund. Now the appraisal's done based on that. So what ends up happening is if it appraises at 315, great, you got 3.5% down against your 315, and then the loan is pretty much identical to what you were intending to. Let's say it comes in at 300,000, didn't add anything value to the property. Well, now you're going to come out of pocket $15,000 to put that HVAC system in yourself. Okay.
Gotcha.
But you still get, the loan is based on your off, you put the offer out as whatever you want to, and then we do more with trying to get the stuff that you want done to the property. And these are also, you can use these for anybody that's let's say wants to, they're a seller and they want to update their home, but the home's messed up, and they don't have the money. Well, they can do a refinance and do these as well. Okay, just have to have equity. And the refinance, oftentimes, let's say they've been in the house for 15, 20 years and they got a lot of equity. Well, they can do a refinance when using one of these products and not come out of pocket any money, because the closing costs and everything can get rolled into it. And they can do a renovation. I got one right now where the house worth about 170 the way it is. She's doing about $140,000 worth of work to it. She has an $89,000 note on it, so she's in for 270. The house can be worth like 300, 325 when it's done, and she's coming to the table with nothing. She's getting $140,000 to do the renovation, and she's coming to the table with $600. Okay, because everything's built into it. So they're great products for doing that kind of, getting your sellers better positioned. Okay. So that's the 203K. The conventional version of this is called home style. Okay. Now home style, you can go up to really not 97, it's 95. 97 is only if you're a home ready. It's not 95. It's 95% on single residence, 90 on 2, 85% LTV, and 75% on 3 and 4 units. The nice thing about the scope of work is a little bit different. The scope of work cannot exceed 75% of the ARV. Okay, so it's a little bit truncated there. And the remaining guidelines pretty much mirror the 203K, except with these you can do. How do I back up? All right, I don't know how to back up. Hold on. How do I? Oh, I know what I do. Escape. There we go. Okay, with these, well, I'm just going to expand again. With these, you can do luxury items. So these you can add pools. These you can do an additional dwelling unit or outdoor kitchen or something like that. Okay, and these are also available now for investment property. All right. They will loan up to it's 80% on investment property. So, but of ARV. So again, so long as it's a 20% equity, it's just like any investment product, but you can do this with investment products. That's new. We used to not be able to do that. So it's a very useful product for that. Regular conventional loan. They have, again, all the same things with a contractor. There's a limited version of these too. So this is just the conventional product of this scope. Okay.
Are the interest rates comparable, or are they about the same?
They're a little bit higher. They're a little bit higher. They're typically about a half a point higher than your regular conventional loan or your regular FHA loan. Okay. That's not onerous. So, for instance, the 203K that I'm doing right now, she has 640 credit score and her interest rate's 5.75. It's not bad at all. Okay. The pitfalls in here, I've talked a little bit about them. Timing, especially in purchases, that's what I've warned you about. 45 days. Making sure contractor strength is a big part of it. Got it. When you're going to use these things, we got to identify a contractor, get them approved ahead of time, and then move forward. And appraisals. So again, if the appraisal doesn't come in what you think, so when you're doing these, you got to be real careful. You got to be real honest with yourself when you're looking the borrower and you're saying, and let's say you're going after property, you got to be real honest with yourself about what your comps are telling you, and don't overshoot. Okay, because if you overshoot and you think maybe it'll get to 350, but the comps really say 325. Well, you could be exposing your borrower to a $25,000 shortfall. Okay, so you got to be careful with the appraisals on these and be real honest with yourself when you're doing your comps. Okay. Okay, so we talked already a little bit about strategy and marketing to sellers and buyers with that. Okay. So we're going to move on to no income verification investment loans. Now, these are otherwise known as DSCR loans. Have any of you ever heard of these? Yes, no? Okay.
Is that statement loans? Is that the same thing as a statement loan? No.
No, this is a no income verification loan. So it's an asset-based loan. It has nothing to do with the borrower's income at all. When we fill out an application for these loans, we leave the income section blank. Okay. All it looks at is down payment, which has to be 20% minimum, credit score, which needs to be at least a 660. Okay. And if it's 660, it's going to be 25% down. But if above 700, it's 20% down. And when you do these are great investment loans. These are great for people, that want to get into something quick and don't want to go through the rigmarole of doing their tax returns or can't or whatever, but they have money and they have credit. Okay. They're only for investment purposes, not for primary residence. And what ends up happening with them is the interest rates on these are probably right now about 8.75. You've got about 700 plus credit, or 8.75, 9, right around there. Okay. When they do the appraisal with these loans, they run what's called a rental analysis on it. They'll look at the rent around the area, and if the rent covers the payment, then you're good. That's all they care about. Okay.
So they don't care if you have a renter. You don't have to have a renter lined up to go.
Nope. They don't care about that. They're going to go, and even if there is a renter in there or whatever, they're going to go off whatever that rental analysis says. They're not going to go off whatever lease is written on the property. They're going to go off what that rental analysis says. Okay. So,
what kind of a collateral securities is personal guarantee also, or is just on the house, second mortgage? What kind of securities are required to get this kind of a loan?
A credit
20% down in credit score. That's it.
No, credit score. What kind of a security is being offered for that? Is it personal guarantee also required, or just a house mortgage?
No, you're signing for the mortgage. Sure. Yeah, you're signing. Yeah.
No, I am signing the mortgage, but I am personally liable for that, or no? Or is it on the property only?
No, you're liable for it. Every loan I'm going to talk to you about, you're liable for. There's no I'm not talking about business loans. This is not a business loan. This is you're personally signing for the mortgage. So,
okay.
I should say it's not just 20% down in credit score. They do have like reserve requirements too. So certain, like 6 months reserves is usually typical. So, when at post closing, you have to have 6 months of payments in reserves. So there are a few other guidelines like that with it. You have to have a primary residence. You can't do it. Well, there are a couple of banks left that will still let us do a DSCR without the borrower having a primary. But they're getting pretty thin about that because people.
So their reserve,
occupancy fraud.
their reserve qualification, does that have to be liquid or can it be in stock you have somewhere else?
Yeah, it can be stock. It needs to be it can be stock, it could be 401k, it can be, just some sort of identifiable asset.
Okay.
Okay. That you have access to. So for instance, like, a teacher retirement who doesn't have access to it, that doesn't count. Okay. But these are great loans, very, very flexible, very easy to do. Let's see, there's really we talked about, there's not really any downside to them. Okay. Alternative income loans. So under the account, under this category, we have a bank statement loan. I'm sure you've heard about these. Okay. Bank statement loans are really great products for people who are self-employed. Like, I just talked to a guy today, he's self-employed, but he hasn't filed his tax returns for a couple of years because he's divorced and he doesn't want his wife to know what his child's, what he's making. So he hasn't filed tax returns. Okay. So, or people who have businesses, and like realtors who have businesses and they deplete all their income off their tax returns. So they don't have much taxable income. And then they have a problem. So these loans came along for these kinds of people. They're typically about 1% higher than your traditional conventional loan. You can do up to 90% you can have a 10% down on these with a 700 plus credit score. And then anything 680 to 700 is 15% down, and 680 to 660, it's going to be 20% down. And then they don't do anything below 660 with these. The way they work, you get 100%. If you're using personal bank statements, you get 100% of the average deposits that you have over the last 12 or 24 months. And if you're using business bank statements, they're going to take the average deposits over the last 12 to 24 months. You have to be 2 years in business. Okay. So you have 2 years of the tax returns or 2 years of the bank statements, but you can use qualifying, either 24 or 12, depending on what's better for you. And their interest rate's a little bit different. So like if you're only you're only using 12%, 12 months, it's about a quarter point higher. Okay. Than doing 24. But it can be a big difference. Like, people who just got started and their last year, their business was, 2 years ago, their business was just getting off the ground. This year it really took off. They've got the 2 years in business, but the 2-year average is low. We can just go with the 12-month average and run with it. Okay. They'll do an average on the monthly deposits, and they're going to assign an expense ratio anywhere between 30 to 70%, depending on this, the default is 30. You wouldn't get into 70% unless you're like, I don't know, running a restaurant or something, and you got a lot of employees. You got, and the other thing that will dictate this is, other than them assigning a expense ratio, is if you have a CPA who will testify on paper, hey, the expense ratio is X of this business, and then they will go with that, and it could be 20%, 10%. And these are great. I mean, these are truck drivers are great for these. They are like one of the best for it because they run a tremendous contractors to run a tremendous amount of money through their business. I have one contractor. His tax returns showed he made like, I don't know, 400,000 in the year, and he ended up paying taxes on like 60. And he just couldn't. But when we're in a bank statement loan, he's like getting $30,000 a month in income. You can buy anything you want, really. Okay, so that's what these were designed for, and they're very useful. Okay, asset depletion loans. This is kind of rarely used. What they're really designed for is retired people. Okay, So what these do is, let's say you have a retired person who has $1 million asset in the bank. You know, that they've retired, they got no other income coming in, but they got $1 million in a bank account. When you use asset depletion in regular qualifying loans, you have to deplete it over 360 months. In non-QM, the true asset depletion loan, we can take an asset and deplete it over 60 months, 5 years. So let's say someone with just $250,000 in their account, that's $4,166 a month in income. So you can go buy a house at that, and that's just $250,000 in the bank. Okay, so these are really good for people who are on a fixed income, retired, and please understand, when I say that these basic qualifications, there are always others. Okay, there are reserve requirements, there are other things that go on in here, but I'm trying to give you the overview of where they can be useful. Okay. ITIN loans in ITIN number of people. If you have these, if some of you cater to this market, we can do ITIN loans. Down payment requirements on those are either 15, 20, or 25%. 15% is available for people who have developed a credit score, have a certain amount. They have to have like one account that's got 3 years of history, 2 accounts that have got 12 months of history, and a score above 700. Okay, and ITIN borrowers can have credit because the TransUnion tracks that. So they get a credit card, they start building their credit. They can have credit scores. Okay, if they have something under 700 and they don't have the correct credit profile, then they're going to be at 20% down. If they have no credit profile, then it's 25% down.
So
okay?
Do they got to produce tax returns as well?
No.
No?
No, they can be a W-2 employee, so just a regular W-2 person, which you do a W-2, a W-2 loan. We don't need tax returns when you're a W-2 employee. But if they're self-employed, yeah, they need tax returns. If they're 1099, they'll need tax returns. And they'll have to have filed those for a couple of years. And they've thrown a caveat at this recently with these. We used to just be able to do these with just the ITIN letter. There's a little letter they get. This is because of their ITIN status. But they're now requiring that you have a visa, some kind of a entry document, visas. You just can't be a complete illegal showing up with an ITIN. You have to have like even if it's expired, like an original visa when you came across the border or something. Okay.
Oh, that's good. I think that's good.
Yeah. So
Trevor, I have a quick question.
Mhm.
Because I had somebody that was asking about an ITIN a few months back. So just to confirm, with an ITIN, if they have poor credit or not enough credit or great credit, they can still apply and get approved. And what would the down payment be?
25%.
25.
25%, and the interest rates on these are not fun either. Okay, so the interest rates on these are, if you got good credit, they're 7-8%. If you got bad credit, you're 10, 11, 12%. Okay. So they're available, but they're not fun. Okay.
Yeah, because I had a potential buyer that had an ITIN, but I couldn't help her because who we were with before, I guess they said her credit wasn't good enough.
Mm-hmm.
So I should probably circle back then.
Yeah, absolutely.
Yeah, and I want to also throw out there that one of the new things that's not on this presentation that we have now is owner financing. Okay, we are aligned with a group that provides third-party owner financing, and these guys are one of their primary targets. People who are in the country, if you've got 20% down, they don't care boo about anything to do with credit, income, or otherwise. Okay. They will match you up with an owner financer who will come in. You get to work with them. Basically, the way it works is they do an interview process with that borrower to make sure they're a good fit for the program. They understand the interest rates. The interest rates are going to be anywhere between 11 to 13%. Okay.
Mm-hmm.
And they're going to do some due diligence in how they make income, but if approve them, and they approve just about everybody, so long as they got the 20% down, then they will match them up with an investor, and you go out shopping with that guy as if he's a regular buyer. Okay. And he goes and finds the house that he wants. That's in the range that he's been approved to go buy. And you guys negotiate a contract. He pays for the inspection. He pays for the, that stuff, up front. And then, but the contract's written, but with this third party investor over here. And so when the closing happens, the closing's happening with a third party investor who's a well-heeled, doing a 20% down conventional loan. You're guaranteed to close on it. And this guy over here is going to end up closing the next day on his owner finance loan. Okay. And he will own the property, and it's not a lease purchase or anything. Like, he actually owns the property, actually has title, actually gets the benefits of the taxes and appreciation, can sell the property if he wants. It's a good program. Okay. Another one we have is foreign nationals. So anybody who's not a citizen at all, wants to buy property in the United States, fine. It's got to be investment property. It's 30% down, and they have to produce bank statements from their current country, and they have to be translated to English. Some of these programs will require you to move the money into the States for 30 days or 60 days. Again, it's investment purchases only. Okay. No credit score requirements or anything like that. Next one is subprime, or we used to call subprime. So we do have loans available for sub 580 credit scores. Okay. It's an FHA product. So if you're 580 and above, it's 3.5% down. It's typical 3.5% down loan. Okay. You're going to get truncated between 580 and 600 now. It's like 620. You're going to get truncated on your back end debt ratios and stuff. But if you have between 500 and 580, FHA offers a 10% minimum, 10% down payment program. Okay. And they do restrict DTI to 43 in the back end, unless we have two compensating factors, which, like residual income or better asset, like a lot of leftover assets or something. And they do allow manual underwriting. And this is also available. You're also in FHA, you can get a regular 3.5% down loan program if you have no credit score. If you're a Zippo, when you pull up and you got no credit, so long as they have 3 alternative trade lines, including rent or phone bill, utility bill that have been in their name for at least 12 months, with good payment history on those, then they can get a traditional 3.5% down FHA loan. Okay.
What's manual underwriting?
Manual underwriting means that they can't get through automated underwriting. So automated underwriting is when we have a system that we run that automatically underwrites the files called AUS. And if we can't get when we run an automated underwriting, what we're looking for is a status called approve eligible. And if it comes back approve eligible, then you're good to go. You're pretty much guaranteed to close that loan as long as nothing changes in your parameters. If it comes back refer eligible, or approve ineligible or something like that, then it can go through manual underwriting. And what that means is they will manually go through and underwrite the file. They will truncate down the debt ratios and things that are allowed. You can't have more than one collection account in the last year. You can't have any mortgage lates. There's stricter requirements. Sometimes it's not very often we have to do manuals. We see them more like on VA and FHA, but it just means that there's something up with it with their credit that's not letting it go through, but they got to have pretty clean credit in order to do it. Okay. We do have down payment assistance loans here, Jackson Henry, so they are available to us. So And it's the T-Shack program, so we can get 3%, 4%, or 5% down payment assistance loans. They're currently running somewhere in about the high sevens or mid sevens for those. They will cover the down payment. You have to have a 620 minimum credit score. Okay, and so those are great products to have available. And another new one that I want to make you all aware of is we have one-time close construction. Now, this is very much like renovation, but on steroids. Okay, so if you have a guy who wants to buy a piece of land and build his house on it, great, we can do that. Okay, and we can do one-time close construction for a primary residence or investment property. Got a guy who wants to go build a fourplex. We can do investment property on that as well. Okay. Very long list of things that need to happen ahead of time with those, with the contractor, the bid, the builder, what they have to they have to go through a very detailed process of their project analysis and everything being done. But they're great programs. If we do one-time close construction on a primary residence, it's 95% of the after repair, but the constructed value of the home is what they will loan up to. Same with and you have to have a 700 credit score minimum to do those. Excuse me.
Now, what's the difference between a one-time close and a regular construction loan?
One-time closing is where you're buying the land and doing the land and the building project under one loan, one time. Okay. Construction loan is they already own the land, and you're just doing a loan for the construction part.
Okay.
Okay. So either way, we can do it. If you find a buyer who wants to do this, contact me. Again, it's a bit of a longer process. Okay. Long story short, they have a year to build the property. They don't have to requalify. They close on the loan. They've got a year to build the property. No, don't have to requalify. If it goes beyond a year, they have to requalify. And there's a like I said, extensive list of what the builder has to do, and the builder has to be pre-approved. And so again, it's a little bit of a lead-in process. Okay. So that's about my presentation on everything. Do you guys have any questions or question and answers?
I do have one question, Trevor. So I have a family member that wants to purchase, but she wants to purchase either in Arkansas or Dallas. This may be like, I don't know what kind of question, but you can still finance, right? I mean, this bank is nationwide.
Well, no. So when it comes to providing loans, you're basically tied to where your current loan officer is licensed. I am only licensed in Texas. Jackson Henry has some loan officers who are licensed in Florida and a couple other states, but we haven't really gotten to the point where we're out to all states. So no. We're pretty much limited to Texas right now.
So, but if she does, because she mentioned Dallas or Arkansas, but if she does something in Dallas, I can shoot her your way, right?
Yeah, anything in Texas.
Okay, awesome. Thank you.
Whole state of Texas.
Yeah. Now, if she buys in Dallas, you can help her with that contract. If she buys in Arkansas, find an agent to refer her to, after she figures out where she wants to buy, and you can get the referral fee for referring her to an agent in Arkansas.
Okay. Yeah, that's what me and Chad were talking about. Me and Chad actually had a three-way conversation with her yesterday, just to kind of find out where, she was at with everything. But she was set on, honestly, she was set on Dallas, but she kind of mentioned Arkansas, if it was an option, but she does want to go to Dallas.
So I also want to just quickly follow up with you guys, as new realtors that I'm talking to. I would love to be your loan partner for any loans that you have, and I'm very responsive on the phone. So, if you have a buyer that you're talking to and you want to get them pre-qualified or get them talking right away about financing, call me. I'll usually drop what I'm doing and do it. I can do a pre-qual conversation in about 5 minutes, five to 10 minutes, and I'll let you know whether or not, we'll get a good sense quickly of whether or not this person is someone that you can do something with. So, please reach out to me at any time. Okay.
What's
Any
your
other questions?
contact number, Trevor?
Here, I'll put it in the chat.
Because I'm gonna send her your your information, because she's ready
Great.
to try to get a pre-approval.
And will you chat me back here with your email address, and I'll send out an email to you so you have that, or maybe her email, and I can send you both one
Of
together.
course.
Yeah, I can send you everybody's email. That way, if you wanted to send their PowerPoint or just reach out to them, you can.
Sure. Perfect. Is that you or is that your client?
Yep, that's me.
Okay. All right, Jen, I will send you my email, and then you can connect us all by that, or call me, or however you want to do it. Send me a text message. I will reach out to them right away.
All right, perfect. Yeah, she's a very great potential. She's been at her job for like 45 years. So,
Oh, wow.
Great.
yeah, she works for Honeywell. Yeah, she's awesome. She's ready.
Great. Well, let's get her going.
Amen.
Thank you so much, Trevor.
Oh, you're most welcome. And again, if you guys have any questions, anytime, give me a call. Look forward to working with you.
Yeah, the question is this, when you think that the rates are going to be slowed down, because
I'm not,
is very high.
unfortunately, I was of the opinion towards the end of last year that because a lot of what I was reading was they were going to stop doing this in about the third or fourth quarter this year. But the Fed just blew that all out of the water with this last meeting. So they basically made it very clear that they're not going to stop raising rates through this year. They're going to at least 5, maybe 5.5% in the Fed bench rate. So we're going to see at least probably another 0.5 point, before this is out. They will probably start downturning sometime in next year. And the reason that is, and you guys can kind of follow this along, is that the economy is just not cooling off. Okay, you can see the reports. The job reports are through the roof. Incomes, wages are up, spending is up. Nothing is weakening in the economy, and it's all just kind of pushing on pricing. And so it's going to probably stay this way through this year. Probably going to start coming down Q1, Q2 next year. So it's not going to go up, I think, too much more, barring any crazy unforeseen things with wars and whatever. But your buyers should be sitting on the fence right now. It's only just
Did they say when the next hike would be?
Probably June.
June?
Yep.
You think
Yep.
it's going to be hike?
Yeah, they're going to hike it again. Yep. Yeah,
What
they're probably going to do another 1/4 point hike in June.
1/4
at
point.
least.
And just tell me one thing: if you want to buy points, how it works? It still works.
So yeah, I think what you're asking about is the 2-1 buy down programs and all that. So you can always, when it comes to rates, you can always buy down for the long haul. Okay, you can buy down the rate, and there's a certain point where that doesn't make a lot of sense. Okay, the cost to buy it down just doesn't make any sense. Now these 2-1 buy downs that you're hearing a lot about, what those are, they're a little deceiving. You can use them, but if you're going to use them, you have to get seller concessions, and you got to get, if you want a 2-1 buy down, you're going to have to get a 2% seller concession from the seller, okay, to closing costs, because it's a closing cost. All right. And you can't have that much of a closing cost without getting some seller concessions. And essentially what they do is they take that seller concession, they create a pool of money of that amount, 10,000 or whatever, that they create a pool of money, and they set it aside, and then they apply a certain amount every month in the first year to bring it down to an interest rate that was 2% lower than what you secured. And then in the second year, they provide a little less of that, so it's 1%. below what you secure for your interest rate. And then in the third year, it's going to go to what you secured. And the idea being, by the time the 2 years goes out, the interest rates will come down. And that's a good idea. It's good. That's the rationale is sound. Just as you're going to use it, you got to get a seller concession. Okay.
And one more thing, just tell me one thing. Now it's a fixed loans or it's a floating rate of interest which is going?
Fixed loan. So the way the 2-1 buy down programs work, let's say you close it at, you close your loan, your 30-year mortgage at 7.375. Then the first year's payments, they're going to make it so that payment would be equivalent to what your mortgage payment would have been if that interest rate was 5.75. Okay, or 5.375. And then the second year, it's going to be equivalent of what it would be for 4.375. And then the after that, it's going to reset to it's going to be what your payment is when you close on that loan. You're going to see, your payment is X. Third year on, it's going to be X for the remainder of the 30 years.
And what is the normally, if you have so there's no floating rates available in the market?
So ARMs they're there, but because the short-term interest, the short-term lending rate with the Fed is so high. It's just in line with the long-term yield. So the ARMs have never come into play because the short-term lending rate is as high as the long-term lending rate. So they don't make any sense. So they're there. They call them 7.5 SOFR ARMs, but they've just never come into play because the market conditions aren't correct for them.
Okay. Thank you, sir. Thank you very much. It was very knowledgeable. And you see, the only thing which I see is that all these loans are available, but very high cost of.
Well, yeah, it's just, your traditional 800 credit score right now, he's going to be paying, 7.375 he's going to be paying in the 7s right now. And that's just the way it is. You can buy it down and get things and you can do things, but it's just where we are, and it's not, it's not outrageous. I wish it was lower, but one of the most important things to take from this, guys, is if you have somebody who has 20% down, we can get a loan done for them. Okay. When there's owner finance, there's all kinds of stuff out there. If they've got money, then even if they don't have credit, we can get something done. They're willing to take certain terms, but we have a lot. I hope you understand all the different kind of loan products that we have here, and I hope it helps you understand how to generate more buyers, because that's what we're trying to do here with Jackson Henry, help you generate more buyers.
Trevor,
thanks.
I'm sorry, Trevor, really quick. Just off the top of your head, can you think of any first-time home buyer programs that may be available?
So the language of first-time home buyer, the COP program, the nurse program, they're all marketing languages for the same thing, which is down payment assistance loans. Okay, so a down payment assistance loan is a first-time home buyer loan. It's where you get your down payment money up, basically free. Okay. And you have to have a 620 minimum credit score, and they've really blown out the incomes on those. You can have up to $100,000 as a single person now and qualify for down payment assistance. So they've made that much more available. But that's what all the quote unquote first time home buyer programs are.
So a down payment assistance is really just 2 loans. You're taking out one for the mortgage and one for the down payment. A major mortgage and a major loan?
It's either the way the down payment assistance parts work, they're either a grant where it's just given, or it's a bond where after like 3 years, it's a silent second, sits in the back, no interest rate, and after 3 years it goes away.
Oh, and those are government programs that you could help the buyer kind of navigate? Mm-hmm.
Yeah, it's actually state of Texas programs.
Okay.
How much is the limit on that? How much you get it?
620 minimum credit score, max income of 100,000.
Max income 100.
Yeah, unless you're a family of 3 or more, and then I think it's like 130.
And how much money they give?
They can get either 3, 4, or 5%. But the way the programs are working now, when I say 3, 4, or 5, the down payment assistance program charges 1%. So when you get 5%, you actually only get 4. The 3, you get 2. Okay. So but you get it's either 3, 4, or 5.
So somebody that is wanting or needing the down payment assistant program, how much typically will they have to bring to the table?
Well, I've done down payment assistance programs when they come to the table with nothing. In fact, they get money back. That a lot, it depends. If you're able to negotiate as a realtor a contract with down payment assistance loan with say let's say you got a $250,000 house and you're able to get seller paid title and $6,000 in closing cost assistance, that borrower's coming to the table with nothing.
Okay. Practically
nothing. Okay. But if you can't negotiate those, then typically, you're going to have about, on a $200,000 and up, 200 to 300,000, $400,000 house, probably going to be about 3%. Again, its closing costs about another 3% is what it's going to be.
But there is a limit also, no? See, you got an income limit of $100,000. So when
Correct.
you have 100 things, you are capped on not more than 250,000 loan, because
if they get $100,000 in income, they can probably go up to $300,000 if they don't have a lot of debt. So I've seen them get up there a little bit, but you're right. They've gotten it's less of a house because of where the interest rates are now. Was there something else I want to say about those? So they do have to have some money. Okay, so like I talked to a client who wants to use one of these, and they literally had like $500 bank. Well, you can't do anything there. So you've got to have at least, because you're going to have to write an earnest money check, do an inspection fee, write an option check. So you got to have it. The borrower's got to have at least that in the bank. They got to have it.
20,000 in the bank.
Yeah, if they're going to do a $250,000 house, you got to have at least 3,500 in the bank. At least 3,500 to start. And then if you're really good and you get the title and the closing costs, and they're good to go. They can go out and shop, but you got to get the contract written right.
And who is the bank you work with?
It's called Mortgage Financial Solutions, I believe is what it's called. That we run those through.
I have a quick question. How far back of employment and what is it, the assets, the checking account and stuff like that, how far back for the lender? I know it's usually, isn't it like 2 or 3 years?
Okay, so work history requirements are that the borrower has to have demonstrated 2 years of work history through their life. Okay, if they've had any gap of longer than 30 days, then they have to be in their job for at least 30 days. They've had a gap of longer than 6 months, then they've got to be in their job for at least 6 months before income can start. But then that's it. So and then we have to go back, we have to be able to piece together 2 years of work history. So let's say you had a stay-at-home mom, she was working and she stayed home for 5 years, right? We go back to when she was working 5 years ago. We pick up her work history from then to 2 years of work history from then. And so long as she's been back on the job for 6 months, then we can count her income and move forward. As far as assets goes and all that, it's 60 days of seasoning.
60 days of what?
Seasoning for assets. If you're going to be buying a house, they're going to look at your asset statements for the last 60 days, and anything large deposit or anything like that, they're going to trace back, and it can't be like, you can't dump cash in your account like within 60 days.
It's only 60 days? Only 60 days? Okay.
60. Mm-hmm.
Yeah, any entry which is coming within last 60 days, they question, if suppose you borrow money for somebody to show your cash balance in your hand, so they'll ask you from where you got this money. That's a very standard question these days, they ask.
Yep.
So the planning is that if you want to buy a house, you prepare all these things. What is the minimum requirement 2 months before you start.
Yeah.
looking for
Yeah, and but assets can also come from gifts. Gifts are where we get a lot. People who are if they have family that can give them
Yeah.
money, or people that we can call family. That we can do gifts for down payments, and for for primary purchases.
Yeah,
You
those
can-
are available, but yes, if we are doing some, conference or some, bigger forum, then educating new people who are new generation, which is going for a new house. So we have to explain to them that how they have to build up their cash balances and other things.
Mhm.
Very important.
Yeah.
And what about the student loans? People see, some people were asking about to buy a house, but they have a student loan.
So
And-
student loans right now are they're all in deferment. And we have to treat them. So if we see a student loan, we basically have to take 0.5% of the value of the balance and charge that as a payment. So it's 0.5%. So you got $100,000 in student loans, then we got to charge a $500 payment. Okay.
But if there are certain schemes which I was trying to help somebody in the past, and see, there are certain schemes which allows that you have you pay as you earn, right? And if
So
you
yeah,
are,
those are called IBRs, income repayment models. And they will come back. Right now they don't exist because everything's in deferment, right? The whole nationwide, all student loans are stopped. That's supposed to start in June. So in June, there's going to be a court decision, one way or the other, about the Biden forgiveness program. And if there's not a court decision, or it goes against them 60 days later, all student loans will start repayments again. Now, when that happens, these IBRs will come back in. So basically, if the borrower said it goes to the bank and they're only making X amount of dollars, and the bank says, okay, your $80,000 in mortgage, your income-based repayment model says you only need to pay $135 a month, and that's what we use.
so you will use that. But how to get that certification and how to get that information?
You go to the bank. So when the bank, you go to the NELNET, or you call it, or Department of Education, and you apply for an income-based repayment model.
So it is normally, in the internet, which is all done through but when they ask question, they never replied back to us, to my client. Okay, we will give you this. This will be your payment scheme. How much is the payment?
Well, you want to be
We were
careful.
talking
Look,
2
you
years
want to be,
back.
there's a lot of
During the
companies
pandemic.
out there that go, hey, talk to us. We can make it so we give your loan forgiveness. We'll get your loan forgiven, or we'll lower your payment. Those are generally scams that are designed to get for one servicing company to steal it from another servicing company. And that happened to me personally. I got caught with this one by NELNET. If they have a student loan and we get to the point where repayments need to happen, they need to call their current servicer and apply for an income-based payment model with their current servicer. And the government basically says you have to give them this. Okay? I mean, it's if they're making $50,000 a year and they got $100,000 in student loan debt, well, you're only going to be required to be paying like $100 a month, $150 a month.
Yes.
But they don't need to go anywhere or talk to anyone. They go to their current servicer and apply for it.
Okay. Thank you, sir. That's very important information.
I have a question.
Sure.
The owner finance.
Mhm.
Tell me more about that. I had somebody that was asking about owner finance. I had her set up for an auto email, just looking for
So the owner
finance
finance
considered in the MLS, but
So the owner finance program basically says that you got 20% down, we don't care much about much else. Okay. So they got to have 20% down. You can do stated income. You can be a foreign person, you can be an ITIN person, you can be straight out of bankruptcy, you can be foreclosed recently. They don't care. Okay. It's 20% down. And they're gonna put you through. They're gonna put that borrower through a bit of you know, they can't be like completely like no income. Okay, they can't have nothing. You know, but they can be. They have to show something, banking statements or something that shows that they have some income. But it's 20% down, and once they, it's going to be between 11% and 13% for the mortgage that they're going to carry. And you know, the owner finance program will tell them, okay, you know, you were able to buy X amount of house, okay, and then you as the realtor go out shopping for that house, okay, and you're going to be writing a contract and closing not with that guy that you're talking to, not with your borrower who's looking for the owner finance. You're going to be closing with a well-heeled investor who's got 20% down, who's gonna own the main mortgage, and that they're gonna close that transaction with that guy, and then they're gonna turn right around the next day and they're gonna close the owner finance transaction with your guy.
Okay.
You get
Oh.
paid.
So they're going to buy the house, like a third party investor is going to buy the house and then turn around and sell it to the buyer.
The very next day.
Gotcha. Okay.
Yeah. So you as the realtor are, and me as the loan officer are really secure in that deal. You're not really dealing with this guy over here. You're dealing with this investor who's gonna close that loan like that. You're gonna be assured to get your commission, and I'm gonna get mine. So
that opens up
Awesome.
your pool, Beverly, because now your buyer can buy anything with this third party lender that's going to buy it and owner finance it to him.
Right. I'm going to give her a call and see how much. I don't remember how much she said she had saved up. I need to call and talk
and I
to
think
her.
I think that TL Global might actually do 15% down. I think they might actually do 15. So
Okay. Because
Okay.
I'm thinking she said she had like 20,000 and that was several months ago.
So you can't do a lot with 20,000. You know,
Yeah,
but,
it's
you
probably,
know.
it's probably, but that was several months ago. She might have more now.
Mhm.
Mhm.
Yep. All right. So anything else, guys?
So thank you very much.
Thank you.
You're
Thank
welcome.
you.
You're welcome. And I look forward to hearing from you. And Janet, you got my email?
I do. I just sent her a text message. I told her I was going to give you her information. So I'm going to send you her information through email so that, you know, you can get that follow up with her and, you know, see where she's at, hopefully get a pre-approval.
Awesome. Sounds great. Looking forward to it. I'll talk to you tomorrow.
All
Thank
right.
you, Trevor.
Thank you all. Have a great night.
Bye-bye. Bye, guys.
Bye, guys. Thanks.